Ari Talib here with Root Financial Partners, Financial Planner. And in my last video, I spoke about financial planning and what can you expect from a financial plan. Well, in this video, I wanted to do the same thing but with an investment analysis. So Frank and Joanna Miller, not real people, but wanted to take you through an example of what it would look like if we were analyzing your portfolio. And so with people like Frank and Joanna, very much so clients that we work with, they come to us, and after we go through that conversation and understand their fears and their dreams, and we're able to get a very clear sense of what it is that they're looking for, well, now we have the plan, but the investment piece now comes into play. So when we're looking at that, just from a broad view, we first like to say, what do you own? But not just what do you own, what are the funds? So we take a breakdown and we say, okay, based off of everything you own, whether it's a Schwab S&P 500 index, whether it's Harbor Capital Appreciation, institutional fund, whatever it is, we look at all of your funds. And then we break it down and we say, great, so you've got all these funds. The first thing we want to know is, what's the amount of overlap occurring? And what we mean by overlap is, that's great that you have this clear bridge large cap growth fund, but you also have the Harbor Capital Appreciation Fund. And what you see here is that Amazon's in this fund, Amazon's in this fund, Amazon's in this fund, and this fund, and this fund. And what you're seeing is that, yes, Amazon makes up 3.7% of your portfolio, but by owning all of these various funds, you're paying for unnecessary fees that are essentially owning the same thing. So could we have one fund that owns a certain percentage of Amazon? What's happening is that ClearBridge, although might be a great fund, it's not talking to Harbor Capital, it's not talking to T. Rowe Price and Schwab and Fidelity. And so when we do the same thing for Microsoft and Facebook, is what you see is that there's a bunch of overlap and you can cut down expenses. That's the first thing. Once we go through the holdings, the next thing we like to look at, I'm going to make me smaller here so you can see, get my radio face out of the way there. You can see here, what's the amount in stocks, bonds, alternative investments, and cash. And so when we're looking at this, 84% in stocks, 11% in bonds, not good or bad, it just fully depends on what it is the client is looking for. And so what we like to do is break it down and have a conversation and first understand, is the goal to have growth? And of course, if it is, at what extent? Are you able to sleep at night knowing the stock market's going up and down? Do you need a certain growth rate to be able to retire early? Do you need a certain growth rate to be able to make sure that you don't outlive your money? What does that all look like? Well, it tailors into your financial plan. The next thing is we do a stock analysis and say, what percent of the stocks that you own are growth oriented? You see here that Frank and Joanna, 42%, look at that, is in the growth and large section, meaning large growth companies. Facebook, Amazon, Netflix, Google, they've done great the past 10 years. But historically, small companies have performed better. And so if we look at this, it's not a question of do we want small or mid or large, it's about diversifying, but does it make more sense to own more small companies, knowing that large companies are at higher valuations? Does it make sense to try to get in at other companies with more attractive valuations? So all things that we weigh in conversations we have. The next thing here, and I'm going through this quickly just to give you a good sense of what this looks like, is if you're looking at where do you own the companies, it's great that 82% is in North America. We want the core of our portfolio to be in America, but at the same time, if we're not looking around the globe, there's opportunity that we're missing out on. There's extra growth that's out there. So the last thing, and the thing that most people don't like to talk about, is the price we pay for investing. It's fun to talk about how much we're going to earn, but what about the other side? What about when we stress test this? The tech bubble, World Trade Center, subprime crisis, debt ceiling, coronavirus went down 40% in just about 5 weeks. Now it's recovered and even more since then, but how did that feel? Were you able to sleep at night? Did you take the approach of understanding that when your investments are going up and down, that historically investments have risen, and the alternative of not investing, well, then there's purchasing power risk, there's inflation. And so is there a balance there that we can combat? That's all things that we talk through. And the last thing here is what I like to call the fees. And right here, these are the net expense ratio, meaning what's the fee you're paying to own each of these mutual funds? Not something that you often see. It's not very clear. Their job is not to debatable there, but as a fiduciary, our job is to very clearly outline fees, and they're not always so transparent. So that's pretty much everything here when we're going through an investment analysis. Now, it's tailored differently to each person, but we want to give you a sense of what that looks like.